Is investing harder or easier than before? What is the nature of investing? Does technology, information, progress, does it make it easier to make money in the markets? Is it the same? I want to discuss this topic today. This is the Not Even Wrong podcast. It's May 22nd, 2021. This is Krim Delco. Since the last update, we are down roughly 50 basis points. The market is up 20 basis points. For the year, we are down 19.6%. The market is up 9.7%. We're underperforming by 29.3%. It's a Saturday today, so there is no further update. And I just want to jump into the topic of today. I want to give some context. I started The Science of Can and Can't by Chiara Marletto. It's a book, I think, a fundamental, life-changing book. I just have a sense that this is one of those books. Chiara works with David Deutsch, so this is pretty much down our alley, down our principal stack alley. And I wouldn't be surprised if The Science of Can and Can't actually enters our principal stack. But I just started reading the book, and therefore it's very premature to even make any conclusions. But here's just in the prelude by David Deutsch, he says the following. He says, imagine a computer memory which is sort of hard-coded in the factory. So meaning what you can store in that memory is defined in the factory. And what kind of memory would that be? I think you would have a very limited computer, and certainly we don't think that that's how we make computer memory. And then he says a fundamental thing. He says, now change factory with Big Bang. Just change that word and say, imagine a computer memory which is hard-coded by the Big Bang, meaning everything is deterministic, there's no free will, everything is predetermined, etc. And you can see already where this book is going. You can see what kind of thinking it is provoking. The optimism, the ability to change, the ability to adapt, the ability to universally solve problems, all these thoughts that are fundamental in David Deutsch's work come through here. Marletto is going to talk about counterfactuals. She's going to talk about new modes of explanation. Deutsch in his prelude talks about the lack of new modes. So he says by the end of the 19th, early 20th century, we had all these new modes of explaining things, quantum superposition, the theory of computation by Turing in the 30s. And today we're just sort of shut up and calculate kind of people. And this is the arch I want to do or dare to do from the physics and epistemology world into the investment world, because it seems to me very similar. We're in a shut up and calculate type of world. We're incremental. We have the same modes of explanation of how to make money, which go back to Harry Markowitz of diversification, Bill Graham, I think it was Bill or some person with the name of Graham, which was the prelude to Warren Buffett, which is value investing and diversification and maybe a few other things such as a broad portfolio and things like that, which is the same thing as diversification. So we have the same modes of explanation of how to navigate financial markets. And I want to make a case here that we need new modes of explanation, that fundamentally that there are certain laws of investing, like the laws of physics, that are universal, that don't change. They have been the same during the Medici times, in the Renaissance. They're the same today, and they were the same during the Babylonian times. And of course, there is a constant new evolution and new technologies which enable us to differently attack certain problems. The same way that we have universal laws of physics that allow us to build bridges and computers, and then hopefully rockets to Mars, and so on and so forth. So we do refine our knowledge, and we do refine the instantiation of the laws of physics in terms of how we can actually develop technology. But fundamentally, those universal laws of physics don't change. And the key message from David Deutsch is, of course, what is possible, what is not prohibited by the laws of physics will happen eventually. And I wanna use this sort of this line of thought and try to implement it into the investment world, because I believe the same thing applies to investing. Investing is part of nature. Nature underlies the laws of physics, so investing underlies the laws of physics. And like Brett Hall says in his fantastic podcast about fabric of reality, you should be very careful by using certain sciences in certain applications. So I don't want to use theoretical physics to develop a theory of investing. I think this would be a mismatch and ridiculous. I need a theory of finance and investing, economics and psychology maybe, to understand investing much better. But I can still start with the fundamental laws of physics, just because, and less so because of the actual laws, but more of the actual spirit of thinking about investing in terms of fundamental first principles. So here are sort of my fundamental, let's say, my building blocks, the way I think about investing. And first and foremost, investing is defined as having money you don't need today. So you have access to capital which instantiates itself in some sort of money, Bitcoin, gold, or dollars. So it's something that you have the power to spend that you don't need to spend because you are not hungry, or you don't need to take your girlfriend out for dinner, or whatever it is you need to do. You don't need to do that. You have the luxury to forego consumption, and you can therefore invest. Now, this is, of course, we call that savings, we call that capital, but I find that always very interesting. Every Finance 101 class starts with, what is investing, and we never actually talk about this because it is important. It goes back to every conversation I have with a customer, which is, listen, first and foremost, the money you're giving to me, I'm a hedge fund manager and you're giving me money, so I should be making money for you. That money should not be necessitated in terms of consumption. You cannot invest and also have necessities in consumption. That's very, very dangerous. There's another word for that. It's called leverage. You can do a little bit of that. We at Orange Capital Partners are doing some of that, but there's a certain limit to how much you can do based on just the laws of survival and things like that. So that's so money you don't need to spend right now. Now, the question is, why are you investing that money? Because you're expecting a return. You want to make more money. And the question here is, why should you be able to do that? Is there anything in the laws of physics or in economics, which is a derivation of the laws of physics, that tells us that that should not be the case? Meaning, is this counter are we trying to build a perpetuum mobile here, or something which is larger than the speed of light? Like, is this even possible? And the theory of competition in economics would say, no, it's not possible to make a return beyond a certain basic return because of competition. So this is the theory. And the explanation would be that because if I have the ability to make, let's say, a high return, then others will follow me. And in a liquid, transparent market, there will quickly be a sort of, call it IX, so the return or RX, sort of natural return on capital that you cannot exceed. So the question now is, why am I at Orange Capital Partners confident going out there and expecting to make 15% unlevered return after taxes and after fees and commissions, when that RX certainly is much lower? Now, what is RX? RX depends on the well, what does RX depend on, actually? This is a good question, and I think there's a couple of things that RX comes into play. One is the growth of the economy. So in North Korea, RX is relatively low because the economy is static. RX is a function of the growth of the economy. If there's a lot of innovation, so let's say, if there's a lot of David Deutsches out there that believe that everything is possible, which is not prohibited by the laws of physics, if people have access to capital and entrepreneurs have the willingness and the ability to create new things, then there's a much higher chance that we will have more innovation, and innovation drives returns. Why does innovation drive returns? Because at least in early stages, every innovation is, and this is now 0 to 1, you can only create sustain innovation by being unique and having, at least for a while, a monopoly. And the monopoly allows for excess returns because competition cannot catch up. So, but according to the Miller-Modigliani theorem, which is a bit of a theoretical thing that I don't want to go into here, but basically what they're saying is that no matter what entrepreneurs do, no matter what the capital structure is of companies, investors will always make sure that the return goes down to Rx, because the return on an investment from an investor's perspective does not actually depend on the company and its innovation. It depends on the investors which invest in the company. In other words, if you have let's say if an equity is underpriced, it will very quickly find its Rx type of price or equilibrium type of price. Now this is of course almost Austrian old school economics, equilibrium time economics, and I am pretty sure that a lot of people will tell me, listen, this is passé, this doesn't happen. There are returns in the market above Rx. I would argue that it is very, very difficult to achieve, and that this illusion of control that we have, that we can actually invest and make money because, oh, I bought Shopify, I bought Amazon, I bought Tesla, that's an illusion, because over an aggregate number of people, or if you play that game many, many times, you will fail many times and succeed a few times, and in the end, on average, you will have that Rx. So it is a random thing. It is a thing that maybe in the multiverse, it's kind of like the suicide quantum game, where, well, if you commit suicide every time you don't actually invest in something which is higher than Rx, then you will be a successful investor. But over many, many iterations of that game, you will always end up with Rx. So my point here being that as a human being, at least given the technology and the modes of explanation that we have today, it is very difficult to conceive a situation where you can exceed Rx. And the reason for that, again, is because it is very difficult to have preconceived or predetermined algorithmic way to continuously find investments which are going to give you returns that are above Rx. And Rx, again, is driven by innovation, is driven by the innovation, the speed of innovation, and those sort of things. So this gets me to the point that really, as an investor, what you are looking for is companies that have high speed of innovation, or like we call it at Orange Capital Partners, low cost of iteration. Low cost of iteration, which is the inverse of high speed of innovation. This drives Rx. So what you can do as an investor now, in order to achieve higher returns, is to concentrate your portfolio on those types of investment. I think this is general enough that you will therefore be less of a fool of randomness. Meaning, if you can generalize your investments beyond, let's say, the human aspect, the geographic aspect, the political aspect, and just find companies that have low cost of iteration, you should be able to generate higher Rx. And, higher returns than Rx, which is sort of the average return of an economy. What that means in plain terms is that I think if you look at, let's say, the United States, if you concentrate your portfolio in companies around the Silicon Valley area, you should have higher returns because the cost of iteration for those companies are lower than, let's say, companies that are on Wall Street, or industrial companies or chemical companies, etc. So this is again, this is the way we invest. So we're talking kind of our own book, but it is also, I believe, a very important factor in investing, and it's I think it's a new mode of explanation, because if you go back to Graham and Buffett, and even further back to I don't know, people like people that wrote about investing in the 19th century, that to me has never been mentioned. So this idea that you look for situations where the cost of iteration is low, hence the innovation is high, and the speed of innovation is much higher. And now let's get back to the original question of this episode, which is, okay, now, is it so that investing now is easier, harder, or the same? And I want to contrast that, let's say, with the Medici family in Florence in the, I believe it was in the 15th century, 16th century, not sure, one of those. Have they, because they were, in my view, sort of the first or at least a Renaissance type investor. So I always tell my people, what I do is very similar to what they did. I take risks. I am a risk taker, just a modern version of a risk taker, and the Medici just were sort of the first, again, out of the Renaissance. So there were risk takers even before the Roman Empire, the Egyptians, the Babylonians, but then there was sort of the Dark Ages, the Middle Ages, and now we have the Renaissance. What did the Medici do? They invested, let's say, in ships, in transportation. They brought international trade. They brought cloth from China and things like that. So the kinds of risks that they took were the kinds of risks where you had high uncertainty and lots of liquidity risk, because you had to invest in something today which then came back to you along in months, sometimes years. So you had to take liquidity risk, inventory risk, those sort of risks that were risks that were new, and they promised very high returns. Now, let's talk a little bit about today. What are the kinds of risks we have today? Let's say when we invest in Tesla, is this similar to, let's say, the Medici family financing a ship which goes to India to bring spices? What is the risk of a ship going to India to bring spices? Again, it's inventory risk. It's, of course, uncertainty. The ship could sink. It could be pirated. And there is liquidity. Well, once I bring the spices back, can I sell them? How about Tesla? Tesla's risk is what we call technology risk. So Tesla has all the risks that the Medici had, which is, again, inventory risk, liquidity risk. There's the term structure there. You have to wait for the money, which is what I call the inventory risk. You have to kind of store your money somewhere and wait till it comes back. In terms of the Medici, that meant that the ship had to go to India and then come back. And in terms of Tesla, what it means is you have to build, let's say, the 4680 battery. It just will take 2-3 years until that battery is in full production, and until then, capital is tied up, and you have to be patient. So in that sense, it's the same risk. However, the technology risk, the technology risk, which is the risk of inventing something, instantiating something. Based on science and the knowledge, scientific knowledge, into engineering, that kind of risk was, I would say, less prevalent in the Medici world, because the technology risk in the Medici world was sailing, and it was, I would say, weaponry and how to defend against pirates and how to defend against attacks in India and then attacks in Florence when the goods came back. So you had to have innovation in weaponry and sailing and those sort of things, but you didn't have the kind of technology risk that, let's say, a Tesla has today, or a Shopify, or Nvidia, where you really have to tinker around with atoms and find ways, or software and both, or let's say AI is a good example, where you tinker around with atoms and software to solve a problem which is relatively difficult to solve given our knowledge today, and that's what we call a leap or an inflection point, etc. So that's why I think, I guess the conclusion of this episode would be that investing is harder today than it was before. And here's why. Investing is harder today than it was before, the same way that I would say writing an essay is harder today than it was before. Today, writing an essay is harder because you have access to information through Google. You have a lot of access to information. So just having information or having knowledge about things is not enough to justify your essay. You have to be more creative. You have to make another step versus maybe 500 years ago, just having knowledge, just knowing what's the capital of, let's say, Belgium or something like that was already amazing, because it was very difficult to access that kind of information. So in the same realm, I personally believe that investing is harder today because a lot of low-hanging fruits are taken because of the access to the markets, the transparency, and those sort of things. It's harder in a sense that you have to have more creativity. You have to jump out of your comfort zone a little bit more than before. That's sort of my conclusion. I think I'm a bit on thin ice here because I have to define comfort zone. I have to define harder. I have to, what does that actually mean? Well, it's the flip side of harder is there are higher returns possible than during the Medici times. This is what I'm saying also. So that's why we at Orange Capital Partners are comfortable with 15% unlevered return, even though RX, given the current circumstances of treasury rates and things like that, and the growth of the economy is very low, we believe we can have very high returns because we have this ability through creativity and through different modes of explanation to actually access investments that have very high returns. And the different mode of explanation, which means basically that not just that we have to find explanation why is Tesla a good investment, but also the way we explain why Tesla is a good investment has to change. For example, from, oh, it's a diversified technology company, which would be sort of an old way to explain, to maybe, oh, it's a company which is run by a person that thinks differently, and because of that, the whole organization thinks differently, and this differently is reason enough to believe in higher innovation, because this thinking differently, Elon Musk thinks differently in the sense that all he wants to do is lower the cost of iteration. That's what's different about Elon Musk than, let's say, somebody at General Mills or at US Steel or at, I don't know, Ford. He is obsessed with lowering the cost of iteration. And this is a new mode of explanation in why we believe investing is going to be more successful now. So the conclusion in this episode is the initial question was, is investing harder today than it was before? The answer is yes. However, that also leads to the conclusion that we can expect higher returns. And the reason it's harder is because we have to find continuous new modes of explanation for why we're investing in things, and therefore we also have a higher probability, a higher chance of finding investments which give us excess returns. Thank you.